5 handouts, and then we're going to do some of the problems out of the textbook. And we're going to do some inventory ones that aren't too bad, and then we're going to do some long-term asset ones, which one's not too bad and one's kind of a pain, but we'll go through those. Okay, so here's what we're going to do. So this is problem 15 in the textbook. I've altered them a little bit just to make them a little easier to use. But let me write out what this is. So this is Beach Corporation or inventory. This is lower of cost or market. Oh, I'm sorry. Cost or net realizable value. I don't know what I've got, but it okay, so this is lower of cost or net realizable value. Okay, so we have our costs. It's pretty easy. And now we need find our net realizable value. And we come down here and they tell us that 5% of the selling price of each of these is our selling cost. So 5% of those we're going to put in there. Okay, so 5% of 160. For calculator. I'll try to turn the mic off when I cough, but $8. Okay, so that's going to take away from our net realizable value. $8. 140 is probably 7. And 80 is probably 4. I should know that one. Yeah, because 10% would be 8. That's one crazy number there. 4. Okay. So the net realizable values for these are 152. 140 minus 7 is 133. And 80 minus 4 is what, 76? So those will be our those will be our net realizable values. Okay, so here's what we're going to do. We are going to compare. Be centered. I don't know. We're going to compare these with, no, they're centered either. There they are. Strange. Okay, with these. And so whichever one is lower, that's the one we're going to go with. Okay, so lower of cost or net realizable value. Okay, so for the first one, this is lower. It's kind of weird. Oh, that's probably why I didn't have it like that. Okay, so this will be 130. Next one, this will be the low. $133 is lower than the 160, so we'll take that one. And 76 is lower than cough. Hold on. Excuse me. Okay, and 76 is the low. Here. So taking the lower of cost or net realizable value, we will come up with a total. Okay, let's see. 130 plus 133 plus 76. $339. Okay, so this is our lower of cost or market. Now we have these on our books over here. So these are on our books at what? What was that? 290, 390, 390. All right. How much do they report on their inventory on their balance sheet? Well, they should 339. So that's on the balance sheet. Now we're going to have to do a little bit for the income statement. Okay, so this is what year one. We'll say 01. How about that? That'll be year one. Okay, so the accounts we're going to use is inventory write-down expense. I think I'll just copy that. Let's see. We're going to write it down from 390 to 339. Okay, so the write down is going to be for $51. I'm gonna put that right down there. We'll make it red. Okay, so this will be $51 of expense. And they say to use the inventory valuation allowance. Okay, so we could just write down the account itself, but oops. But they actually give us an allowance account. And this is going to go on the income statement. Scratch that. This is going to go on the income statement. And this one will go on the balance sheet. So the income statement will have an expense of 51, the lost $51, and we'll also write down our inventory. This would be an allowance account. Hold on a second, I got a cough. Sorry about that. Okay, and so that'll be our write down. Okay, let's go to year 2. Notice our new carry amounts. Those are what we had last time. Okay, so what was that? 339. Okay, now our selling price. They've changed a little bit. So they've gone up to 180 for the first one. So 180 times 5% is 9. Again, we're doing the same thing we did before. Uh, 160 is probably 8. 147. I cooked those numbers a little different than the actual textbook just to make them easier. Okay, so this is 171. And this is 152. And this is what's it, 133. Okay, so here's our so our carry amount is 339. The cost was 390. So the question is, well, which one can we use? Which is one's going to be the lower of cost or market? Okay, well, let's see how I color coded the first ones. Okay. Okay, so oops, just making those the same colors, not very helpful. Okay, lower of cost or market. So this will be the lower of cost or market here. Wacky. Okay, so this will be the low. 160, 152. So this will be the low. And 100 will be the low here. Change you to a lowercase low. Okay, so oops. So if we add all those up, 130 plus 152 plus 100, 382. I'm going to put my calculator just to make sure. Sorry, I sound like a duck right now, but that's the way it is. All right, 382. Okay, so this is our lower of cost or market. Now, we've written down return amount which we should put in their inventory. Oh, 382. Well, I'm not giving much room here, but so 382 is what we should have for our inventory. Now, what we have to do is, oops, underline you. Okay, so make the reversal. Okay, so here's what we do. We have the books at 339. We got to write it up to 382. We can't go above the cost, but we didn't even reach the cost. We're still a little bit down a little bit, but we're going to write it back up from 339 up to 382. Okay, so the reversal will look like 382 minus 339. So we have to reverse out whatever that is. 43. Okay, so this will be our reversal. And I am going to put that right in the equation. Right now, I'm saying here. No, don't do that. There we go. Okay, accounts to use are reversal write down expense. Okay, now you notice up here the expense was a debit, and we always do expenses are virtually always debits. Well, we're going to reverse it. So the reversal of the expense will be a credit, kind of like a gain. And the inventory valuation, instead of reducing the inventory, it will increase it by not 51, but 43. Okay. So we'll see, this is 1231. Oops. Where is it? Okay, so inventory valuation allowance will be here for 43. And the reversal of write-down expenses, this is sort of like a gain. Will be 43. And again, we're going to reverse it out for the 43 to bring it up to the lower cost or net realizable value. So this is what the amount we should have on our books. And so we will write it back up to the extent that it recovered some of it. Now, it didn't recover all of it, but it recovered some of it. How would the above answer differ if used US? That should be gap rather than IFRS. Excuse me. US GAAP does not allow for a reversal of the write down. So there would be no journal entry. So this journal entry up here, we would not do this if this was GAAP. Once it's written down, it's written down. And you kind of find that with U.S. standards that they don't let you recover. Okay. So this is kind of a fundamental difference for especially things like buildings, for the difference between international standards and U.S. standards. International standards, we break out individual components of the building and we depreciate those separately. So for instance, here they have carpeting. Will last for 5 years. The roof will last for 15 years. And the HVAC system, that's a heating system, heating, air conditioning. Heating, ventilation, air conditioning. I think it's just, I don't know. Anyway, those will all be replaced. So in international standards, we break those out separately. U.S. standards, we don't. Now, you say, well, okay, how come we don't for U.S. standards? You know, if they do need to be replaced at those period of time, U.S. standards just counts those as expenses. You know, it'd be an expense that you would have for whatever it is you're doing. So it'd just be a maintenance kind of thing. So international standards say, okay, break them out separately. U.S. standards, we don't. Okay, so international standards, depreciation. Okay, so it'll look like this. Carpeting. How much did they say it was? Carpeting, 10,000. Uh, 5 years. Roof. $15,000. $15 years. And let's see, the heating, ventilation, air conditioning system. Yeah, I'm just gonna copy that. $30,000, and that was for 10 years. Okay, and so then what's left over? Okay, so Yeah, I'm gonna add a row in here. Oh, don't do that, Art. What are you doing? Here. All right, so we had a total we paid for this thing of 500,000. So the question is, how much is left for the building? What is it? 55? 445? Ah, close enough. All right, so this will be 445. 445,000. I'm gonna check that just to make sure. I'm doubting myself now. Minus 10. $445. Okay, so this is, and we'll divide that by 50 years. Okay, so this will be our depreciation. So again, they break it out all separately. 2,000. 15,000 by 50 and 1,000. And 30 divided by 10 is 3,000. All right, sorry about that. What is 445 divided by 50? Uh, 8,900. All right, so this will be the depreciation expense for. I'm gonna bold that. So this will be the depreciation expense for international standards. Again, they break out the components of the building. So this will be. Whatever that is. $14,900. Okay, so that'll be international standards. U.S. standards are. What is it? 10? 10,000? It's 10,000. Yeah. Okay. So this would be international standards. They would depreciate 14,900. And U.S. standards, we would just depreciate the altogether the building. And when we do replace things, we'll just count it as a as expense. Maintenance expense. Okay. So what would it look like at the end of the? Do I give a year on this? The general amount to be recognized as depreciation expense a year 2. Okay, well we'll just say 12/31/02. Depreciation expense is the same as I think I don't know, if you had me in class before, you know that I use it's kind of morbid, but DEAD is always what you use for depreciation. Dead. At the end of its life, it's dead. This is depreciation expense. And this is accumulated depreciation. All right, so the IFRS standards would be 14,900. The gap standards, like this. Okay, so that is just between them. Make the consolidating entry on the US. Did I add that? I must have added that. All right. So what would we do? So consolidating entry. So if you just the consolidating entry would just be reversing out the old one, putting the new one in. So if they're consolidating entry on gap books, the easiest way to do this. And by the way, the easiest way to correct any consolidating entry or any error, anything, anytime you have to change something, the easiest way to do it is just to reverse it. You can think about what how much you have to take out of each one. I would say just it's usually easiest just to reverse it. So I would just reverse this one out. So you get their financial statements, and it shows depreciation expense of 14,900. You say, well, that's not right. Um, Reverse that one out, put the correct one in. Yeah, I shouldn't say correct one in this case, but put the U.S. standard one in. So this would reverse out. International standards. And you just put the U.S. one. And again, whenever I know that you could probably figure out like, oh, how much does the depreciation expense decrease by and all that kind of stuff. It's usually easiest just to do them in totals. And not only that, it kind of shows what happened. Okay, this is taking out the international standards. This is putting in the U.S. standards. All right. 1 second here. All right. So this is the last one we're doing. Hopefully, this is the last one we're doing. Hey, it is. I think. Yeah. Okay. Um, Impairments are big. They're tested quite a bit now, and the whole idea behind impairments being an issue is that you don't want to have something on your books. For instance, let's say you have an asset on your books for, in this case, whatever. Well, let's make it up one. You don't have something on your books for, say, $10,000, and when you look at it, you're only going to have cash flows come in for 6,000. Okay, so you have an asset on your books for 10,000, but you're only going to make 6,000 total over this thing's life. It doesn't make sense to have that on books for $10,000. So there is this idea that assets should be making you money, and that if they are not making you at least what they cost, that they are impaired. So a machine that's only going to make you $6,000 over the next, 3 years, you should write that down to $6,000 because that's the most it could ever come in. Okay, now let's go back to the problem. We make more sense. Okay, so let's see here. We get this piece of equipment. The equipment has a 10-year life, so there's a value depreciated basis. Technological innovations that have taken place in the industry, which the company operates in year 4. Quick gathers information and the following information for this piece of equipment. Okay, so if something happens in the market, or in this case technologically, you are required to take a look at the asset. If things are going along normal and you're making your normal profits on it, there's not a problem. But in this case, we have technological innovations. Oops. All right, so we're going to do it now. How did I misspell it? Oh, I left off an N. All right, let's see. The expected future undiscounted. Oh, okay, so this is the undiscounted future cash flows. Present value of the expected future cash flows. So these are discounted. So the difference between these two is these are discounted. Yeah. So discounted cash flows are always going to be less than undiscounted. You can tell by the name. But discounting is that cash that you get 5 years from now is not going to be worth the same as cash today. So you discount it. There's tables that we do that with. But yeah, so discounting is simply saying, okay, the dollars you receive in the future are not worth as much today. Okay. Now, it gets a little bit wacky in whether it is impaired or not. Okay, let's see where we're at with this. Okay, so this is year 1. It costs 100,000. 10-year life, 0 salvage value, straight line. Okay, we're in year 4. Okay. So let's see what this thing is on our books for. So equipment. It has a cost of 100,000. It's going to last for 10 years. So the depreciation expense will be $10,000 per year. Okay, so what is this on our books for? Book value or carry value? Oops, the same thing. Will look like this. Equipment. $100,000 minus the accumulated depreciation. I can say I'm making these mistakes because I'm sick, but it probably has nothing to do with it. All right. So we had it for 4 years, right? Year 4. There should not be an asterisk there. There should be a minus there. Okay. So minus the accumulated depreciation. So the book value or the carry value. I'll probably say carry value. Is 60,000. Okay. Now, the test for whether this is impaired or not differs between the US standards and international standards. The international standards will use the carry value the international standards are probably theoretically better than the US standards on this one. The carry value, which is 60,000, versus the discounted cash flows, which is was it 52,000? Where are we at? 52,000. So this would be yes. The 52,000, the discounted cash flows is less than the 60. It's impaired. Now, here's the wacky thing about the US standards. We use the undiscounted cash flows. Now, theoretically, this is not as good as the international standards. You should be using the discounted cash flows. I'm not sure if they do it for just to make it easier to use or what, but So the undiscounted cash flows will tell you if it's impaired. And in this case, it is, because the undiscounted cash flows are still less than the carry value. So it is going to be an impairment. Now, here's the wacky thing. We're both US standards and international standards. If it is impaired, we use the discounted cash flows. And we do not look at the market price on these. We look at the higher of these two, basically. Okay. So the higher of the discounted cash flows is 52,000. And the selling price. And the idea is that if the selling price was higher, you could just go ahead and sell it today and get more money out of it. If the selling, if the discounted cash flow is 52,000, but you can sell it for 55, well, just sell it for 55, and you'd be better off doing that. Oh wait, I put I was talking, making an example, and I put that in as if it was a fact. It's not a fact. Okay, so the 52,000 would be what we'd write it up, and that would be for both the U.S. standards and the international standards. So it is a little bit strange in that U.S. standards are the undiscounted cash flows. Because if the undiscounted cash flows, for instance, were 62,000, there would be no write down for the U.S. standards, and the international standards would have a write down. And truthfully, the 52,000 is the value of what's coming in for this machine. We do discount cash flows going into the future. Okay. Make all the journal entries on December 31st for year 4. It doesn't show that we actually, we'll do the depreciation expense. Okay, so I think we still put the depreciation expense. Oop. Which is 10,000 a year. And the accumulated depreciation $10,000. Now we're also going to have to write down this equipment. So we're going to So sorry. All right. So we're gonna have to write this down. So we're gonna have an impairment loss. I'm gonna copy that. And equipment. Let's copy that too. Let's bold this whole thing. All right. Let's see. Our loss was what? 52 compared to the carry value of 60. So this is the carry value. This is the higher of the discounted and the market. So the difference between those two, 60 minus 52 is 8. Okay. And so we'll write down the equipment by 8. Okay. Oh, more fun. Oh, okay, right. This is gonna be a reversal thing. All right, so required make the depreciation entries for December 31st for year 5 and year 6. Okay, now we have to figure out how much of this is going to be left after we do the can I copy and paste something up here? Yeah, here we go. See, teaching you how to be lazy. All right. So now remember that this actually isn't really what we're doing with now. We've written down the equipment by 8,000. So this equipment is 100,000 minus 8. 92,000. So what's 92 minus 42? Oh, that's 52, right? That's what we, yeah, okay. That's what we're writing it down to. So after the write down is what we'd have. All right. So the carry value is 52,000, and we have 4 years have gone by, so there's still 6 years left, right? So 52,000 divided by 6 years. I don't think that's going to be a nice number. Change 52,000 divided by 6 years. Blah. All right. We're rounding off the nearest dollar. So this would be 8,667 per year. So we wrote it down by 8,000. There's 52,000 value of this thing left. We're going to write off over 6 years. And this yucky number is what we're going to use for. Okay. All right. So this is year 5, year 6. Okay. Well, same thing as up here. We're just going to, I'm going to copy and paste it. This will be 8,667. 1,667, and that's from and it's straight line, so this will be exactly the same thing down here. So these are the new depreciation. By the way, the CPA exam, they do get into the depreciation stuff, and it's not hard. It's just tedious. You know, you got to really pay attention to the dates and stuff on it when you do the depreciation stuff. And I remember when I took the CPA exam, we did it by hand, so it was archaic, anyways. But I remember there was one problem that had to do with depreciation, and I thought, okay, depreciation is really easy, you know, and it was just, you know, and it took forever because they had all these different dates in it, and you know, the revisions and all this stuff and stuff. You know, it's just tedious. It's not really hard. It's just tedious. Okay. At the end of year 6, it is discovered that technological innovations related to this equipment were not as effective as first expected. Quick estimates of the following for this piece of equipment in year 6. Okay, so well, we got to do this again. First of all, we got to figure out how much the accumulated depreciation is. Okay, I'm gonna put it in between here. You know what? I'm going to. Okay, so our equipment is 92,000. Our accumulated depreciation. I'm going to do the math right here. Just I don't know why. Be lazy. So 40,000 was in our accumulated depreciation, but then these next 2 years we depreciated 8,667. Probably could multiply that by 2, but we'll just leave it like that. Okay, so we'll come up with a new carry value. Get rid of this for now. Okay, so our new accumulated depreciation is all right. I'm talking to myself. 57,334. Hey, yeah. Okay. All right. So our new carry value is $34,666. Okay, so I should have done that. So 34,666 is the carry value. Now notice our expected future cash flows undiscounted are 50,000. Our present value of expected for continuing use are 44,000. And the net selling price in the used market is 42,000. Okay, so the question is, well, how much can we write this thing up for? Now, we can only recover what we wrote off before. So we have to go back to the original, all the way up here. So before we did any of this writing down stuff, what would this have been if there was no write down? I realize after 5, if you need to go, that's fine. This will be online too. So if no original write down, if we were in 6 years, this would be what, 60,000? So this would be 60,000. I should have changed this too, because the 6s and the 4s are confusing. So the carry value, if we didn't have any write down, we should have 40,000 on the books. Right now we have 34,666. So we're going to take the lower of these two, the present value, future cash flows, and the market is lower than that anyways. You take the higher of those two, so would it be this one? And we can't write up to 44,000. The most we can write up to is 40. So, so and the market of equipment is 42,000. So the higher of those two, this one's higher. And we take the lower of those two, the lower versus, so we can recoup what was in there, what it would have been up to today. So 40,000. What's the difference between it? So we're going to write up from 34,666 to 40,000. Okay. Can I get that on the same page? Man, that's a long one. Feels like I've been doing this problem for like hours. All right. Yeah, we can break it. Okay. So reversal of impairment. This is kind of like a gain. Let's see, 40,000 minus 34,666. $53.34. 5,334. And we will put that into equipment. So we will recover what's still left. Do I want to do a proof of this thing? Yeah, I'll do a proof of this thing. Okay, so this is what it'll look like when we're done with this. $92,000 plus 5,034, so this would be 97,334. Minus 57,334. That means there's $40,000 left to and this is going to be over 4 years. And you get the idea. We're back to the 10,000 a year, like it never happened for the depreciation expense for the next 4 years, 4 remaining years. Wasn't that fun? I had fun. I don't know if you had fun. I had fun. Anyway, yeah. So that's the doesn't ask about the U.S. standard. U.S. standards will generally they don't allow you to write it back up. They don't allow for recovery. Okay, well that's a fun one. I'll have to put that into your. I don't think I have a drop for that. I didn't think we were going to finish it. Okay, well that's that, and I will see you guys, or at least talk. You have a thing here next week. Questions? All right. See you, Lee.
Well, have a great night.
Oh, you too.